Welcome to Top 10 Today, where we bring you the latest updates on the world's most pressing topics. In this video, we'll discuss the top 10 key economic indicators that are expected to significantly impact the stock market in 2023. As we move towards a new year, it's crucial to stay informed about the factors that may affect your investment's performance. From GDP growth to unemployment rates, we'll analyze the data and trends that are shaping the global economy. We'll also analyze how they may impact the stock market in the coming year. So whether you're a seasoned investor or a newcomer to the world of finance, sit back and enjoy our countdown of the top 10 economic indicators to watch in 2023. Number 10. Unemployment rates. The unemployment rate is a critical economic indicator that measures the percentage of people without a job but actively seeking employment. A high unemployment rate may indicate a lack of job opportunities, which could lead to decreased consumer spending and slowed economic growth. When people are unemployed, they may have less disposable income to spend on goods and services. This can impact businesses and the overall economy. Additionally, high unemployment rates can result to decreased confidence in the economy. This may cause investors to sell off their stocks and move towards safer investments, ultimately leading to a negative impact on the stock market. Number 9. Inflation rates. Inflation is a measure of the rate at which prices for goods and services increase over time. When inflation is high, currency purchasing power decreases, as consumers must pay more for the same goods and services. High inflation rates can reduce consumer spending, as people may be less likely to purchase goods and services due to their higher cost. Additionally, businesses may experience decreased profits as they must spend more money to produce and sell their products. These factors can ultimately negatively impact the stock market. Number 8. Global events. Natural disasters, political instability, and geopolitical tensions are all examples of events that can have a significant impact on the global economy and the stock market. These events can lead to increased uncertainty and volatility in the stock market, as investors become concerned about the potential impact on businesses and the economy as a whole. Natural disasters, such as hurricanes, earthquakes, and floods, can disrupt supply chains and damage infrastructure, leading to decreased economic activity and reduced company profits. Political instability, such as changes in government policies or political unrest, can create uncertainty for businesses and investors, causing them to be cautious about their investments. Geopolitical tensions, such as trade disputes or military conflicts, can also have a significant impact on the stock market, as they can disrupt global trade and create economic uncertainty. Number 7. Consumer confidence. Consumer confidence is an economic indicator that measures consumers' overall optimism about the economy and their financial well-being. Consumer confidence is generally positive for the economy and the stock market. When consumers feel positive about the economy and their financial prospects, they are more likely to spend money. This can increase economic activity and company profits. Increased consumer spending can drive up demand for goods and services, leading to economic growth and higher stock market valuations. Moreover, when consumers are confident in the economy, they may be more likely to invest in the stock market. This may lead to increased demand for stocks and potentially higher stock prices. On the other hand, low levels of consumer confidence can lead to decreased spending and economic activity, which can negatively impact the stock market. Therefore, it is essential to monitor changes in consumer confidence when evaluating the overall health of the economy and the stock market. Number 6. Interest rates. The Federal Reserve plays a critical role in the economy and the stock market. One of its most significant tools is the ability to raise or lower interest rates. Interest rates impact the cost of borrowing and lending money, which affects spending and investment decisions. When the Federal Reserve raises interest rates, borrowing becomes more expensive, and businesses may be less likely to invest in existing projects or expand operations. This can slow economic growth and reduce company profits, which could negatively impact the stock market. On the other hand, when the Federal Reserve lowers interest rates, borrowing becomes cheaper, which stimulates economic growth and increases company profits. This can lead to higher stock market valuations and stock prices. However, lower interest rates can also lead to inflation, which negatively impacts the economy and the stock market. Overall, the Federal Reserve's decision to raise or lower interest rates is closely watched by investors as it can significantly impact the stock market. Number 5. Housing market. The housing market plays a crucial role in the economy and can significantly impact the stock market. Home sales and prices directly impact consumer spending, which drives economic growth. When the housing market is strong, homeowners may feel more financially secure, leading to increased consumer spending and economic growth. This in turn can positively impact the stock market. Conversely, a weak housing market can negatively impact the economy and the stock market. Falling home prices and sales can lead to decreased consumer spending and economic growth, potentially causing a stock market downturn. Number 4. GDP growth. Gross domestic product, GDP, is a key indicator of an economy's overall health. It measures the total value of goods and services produced within a country's borders. High GDP growth rates indicate a robust economy with increased demand for goods and services. This can lead to positive outcomes for the stock market. When GDP growth rates are high, businesses can expand and increase profits. This in turn can lead to increased stock prices and positive returns for investors. Conversely, low GDP growth rates can be a warning sign of an economic slowdown, which could negatively impact the stock market. Investors often closely monitor GDP growth rates as a key indicator of economic health and potential stock market performance. Number 3. Trade deficit. Trade deficits are an essential economic indicator that measures the difference between imports and exports. A high trade deficit can be a warning sign of reduced economic growth and increased debt, potentially affecting the stock market. A high trade deficit can result from a significant increase in imports compared to exports. This can lead to foreign reserves depletion. This in turn can create an unfavorable economic environment, potentially leading to decreased consumer spending and an overall economic slowdown. As a result, investors and economists closely monitor the trade deficit as a key indicator of the country's economic performance and potential impact on the stock market. A trade deficit reduction strategy could positively impact the economy, potentially resulting in higher stock market returns. Number 2. Manufacturing data. Manufacturing data is an essential economic indicator that reflects the economy's health and consumer demand. It includes metrics such as new orders and production levels, which can provide insight into the economy's overall performance. Positive manufacturing data can lead to increased consumer spending and economic growth, potentially benefiting the stock market. A robust manufacturing sector can lead to job creation, wage growth, and economic expansion. This, in turn, can create a favorable environment for businesses to thrive, potentially leading to increased profits and higher stock prices. As a result, investors often closely monitor manufacturing data as an essential economic indicator of potential stock market performance. Positive manufacturing data can signal a healthy economy with strong consumer demand and could lead to increased investor confidence in the stock market. Number 1. Corporate earnings. Earnings reports released by individual companies can impact their stock prices and the overall stock market. Positive earnings reports can lead to increased investor confidence and higher stock prices, while negative earnings reports can result in decreased investor confidence and lower stock prices. Investors monitor companies' earnings reports closely to determine the financial performance of individual companies and the industries they operate in. Companies with positive earnings reports are generally perceived as healthy and can generate increasing investor interest, leading to increased stock prices. On the other hand, negative earnings reports can lead to decreased investor confidence and lower stock prices. This can impact the market as a whole, potentially leading to decreased demand for stocks and a general decline in the stock market. Therefore, earnings reports are a critical indicator of a company's performance and can provide insight into the overall health of the stock market. Thank you for tuning in to Top 10 Today to learn about the key economic indicators that will impact the stock market in 2023. As we've seen a variety of economic factors, from inflation and interest rates to geopolitical events and individual companies' earnings reports, can have significant effects on the stock market. By staying informed and keeping an eye on these indicators, investors can make informed decisions to navigate the stock market ups and downs in the coming year. We hope this video has been informative and useful in your investment journey. Be sure to subscribe to Top 10 Today for more informative content on a range of topics. Leave a comment below to let us know which economic indicators you'll watch closely in the year ahead. Thank you for watching, and we'll see you next time.